Stop right now. If you are about to buy gold or silver today, if you are about to place an order with your dealer, if you are about to click buy on your trading platform, if you are about to wire money for precious metals, you need to see what just happened in the last 12 hours because $380 million in gold and silver positions were liquidated in a violent market purge that is sending shockwaves through commodity trading floors, hedge fund risk desks, and institutional precious metals departments. And this is not normal profit taking. This is not routine position adjustment. This is forced liquidation. This is margin calls hitting hard. This is leveraged players getting obliterated. And the fallout from this massive unwinding is creating both extreme danger and extraordinary opportunity, depending on how you understand what is actually happening right now in real time. As the precious metals market undergoes a violent reset that most retail investors do not see coming and will not understand until it is too late to protect themselves or capitalize on the dislocations that are appearing in both physical and paper markets. The $380 million liquidation event hit commodity exchanges in the early Asian trading session when gold futures suddenly dropped $40 in under 15 minutes. Silver crashed below a critical support level, triggering stop-loss orders across multiple exchanges, and the cascading effect ripped through leveraged long positions held by hedge funds, commodity trading advisors, and speculative accounts that were betting on continued upward momentum in precious metals. And when margin calls came, when brokers demanded immediate cash collateral, when automated risk management systems started force selling positions to meet exchange requirements, the selling pressure became self-reinforcing, creating a liquidation spiral that wiped out billions in paper profits, destroyed hundreds of trading accounts, and sent precious metals prices into a free fall that has now stabilized, but has left the market structure severely damaged and the technical picture completely uncertain for anyone trying to make buy or sell decisions right now without understanding the deeper forces at play. This is why buying gold or silver right this second could be extremely dangerous, because the liquidation event has not fully played out yet, because there are likely more leveraged positions sitting near margin call territory waiting to be triggered if prices drop another 5 or 10%, because the technical damage on the charts is severe with major support levels broken, with moving averages violated, with momentum indicators collapsing, and with sentiment shifting from bullish confidence to panic and fear. And if you rush in to buy right now thinking this is just a dip, thinking this is an opportunity, thinking prices will immediately reverse, you could be catching a falling knife. You could be buying right before another leg down. You could be positioning yourself to take immediate losses that could have been avoided by waiting for confirmation that the liquidation wave has actually ended and that market structure has stabilized enough to support a sustained bounce, rather than a temporary dead cat rally that traps new buyers before rolling over again. The liquidation was triggered by a combination of factors that came together in a perfect storm, including a surprise hawkish statement from a Federal Reserve official suggesting interest rates may need to stay higher for longer, which immediately strengthened the dollar and put pressure on dollar-denominated commodities, a technical breakdown in gold that violated a key chart level that algorithmic trading systems were programmed to react to, a sudden surge in treasury yields that made holding non-yielding assets like precious metals less attractive, and a wave of profit-taking from large institutional players who had accumulated massive long positions over the past several months and decided to lock in gains before potential volatility around upcoming economic data releases. And when all of these factors hit simultaneously, the market structure could not absorb the selling pressure. Liquidity evaporated. Bid-ask spreads widened dramatically, and prices went into a controlled demolition that executed with ruthless efficiency and left retail traders, small investors, and even some professional managers completely blindsided. The danger right now is not just about price direction, it is about market structure, about liquidity, about the gap between paper prices and physical prices, about the reliability of technical signals, and about the risk that another wave of liquidations could hit if broader financial markets destabilize, if the dollar surges further, if treasury yields spike higher, or if a major leverage player blows up and has to unwind even larger positions in a disorderly fashion. And this kind of environment is extremely treacherous for anyone who does not understand how modern commodity markets actually function, how leverage amplifies both gains and losses, how margin calls create forced selling regardless of fundamentals, and how temporary price dislocations can create both catastrophic losses and once-in-a-year buying opportunities depending on timing, positioning, and risk management. Here is what you absolutely must understand before making any move in gold or silver right now. The $380 million liquidation represents leveraged paper positions, not physical metal, which means the futures market, the options market, and the ETF market are where the carnage occurred, while the physical market for coins, bars, and bullion is operating on completely different dynamics, with premiums actually rising in some cases as dealers see buying interest from investors who view the price drop as an opportunity. And this divergence between paper and physical is critical because it tells you that the fundamental demand for precious metals as inflation hedges, safe haven assets, and portfolio diversifiers has not collapsed. What collapsed was speculative leverage. What got destroyed were traders using too much margin. What got liquidated were positions that were sized incorrectly for the volatility environment, and this means the underlying bull case for precious metals has not been invalidated, but the short-term trading environment has become extremely dangerous for anyone who does not respect the technical damage and the potential for further downside before the market finds a durable bottom. The opportunity that is emerging from this chaos is significant, but requires patience, discipline, and a clear understanding of risk. Because if the liquidation wave is truly finished, if margin calls have been satisfied, if forced selling has exhausted itself, then the current price levels in gold and silver represent a potential entry point for investors who have been waiting for a correction, who have been watching precious metals rally and wishing they had bought earlier, who understand that pullbacks in bull markets are normal and healthy and create opportunities for those who are not afraid of short-term volatility. But the key word is IF. Because if the liquidation is not finished, if there is another shoe to drop, if a major fund or institution is still sitting on underwater positions that have not been unwound yet, then prices could drop another 10 or 20% from here before finding support, and buying too early means enduring drawdowns that test your conviction, that force you to question your thesis, that tempt you to sell at exactly the wrong time when capitulation is highest and the bottom is nearest. The actionable insight for viewers right now is this. Do not panic, do not make emotional decisions, do not rush to buy just because prices dropped and you think you are getting a deal, and do not rush to sell if you already own physical metal and are holding for long-term wealth preservation, because liquidation events in paper markets are temporary, they are technical, they are about leverage and forced selling, they are not fundamental changes in the macro environment that supports precious metals, and the factors that have been driving gold and silver higher, including inflation concerns, currency debasement, geopolitical instability, central bank buying, and supply constraints have not changed just because leveraged speculators got wiped out in a margin call cascade that was predictable and inevitable, given how extended positioning had become. If you are planning to buy gold or silver, wait for confirmation that the liquidation has ended. Watch for stabilization in prices. Watch for volume patterns that suggest selling pressure has exhausted. Watch for technical indicators to start turning positive. Watch for the dollar to stop rising. Watch for treasury yields to stabilize, and watch for sentiment to shift from panic to cautious optimism. And those signals could come in days, could come in weeks, but waiting for them could save you from buying into further downside and could position you to enter near the actual bottom rather than on the way down. And the difference between buying the dip and catching a falling knife is timing, confirmation, and respect for market structure that is currently damaged and needs time to repair. If you already own physical gold and silver as part of a long-term wealth preservation strategy, this liquidation event changes nothing about your thesis because you are not trading, you are not using leverage, you are not trying to time short-term moves, you are holding hard assets as insurance against monetary instability, inflation, and systemic risk. And those risks have not diminished. In fact, they have increased as government deficits grow, as debt levels become more unsustainable, as geopolitical tensions escalate, and as central banks remain trapped in policies that require currency debasement. So if anything, this price drop is an opportunity to add to long-term positions at better levels. But only if you have cash available, only if you are not overextended, and only if you can stomach potential further downside in the short term while maintaining conviction in the long-term thesis. The $380 million liquidation is a warning shot about the dangers of leverage, about the risks of chasing momentum, about the importance of position sizing, and about the reality that paper markets can move violently and irrationally in the short term, even when long-term fundamentals remain intact. And this is a lesson that every precious metals investor needs to internalize, because the next major bull leg in gold and silver will be accompanied by multiple liquidation events, multiple corrections, multiple shakeouts designed to flush out weak hands, to punish over-leveraged speculators, and to test the conviction of investors who claim they believe in the precious metals thesis, but have never experienced real volatility or drawdowns that make them question everything. The smart money is watching this liquidation very carefully. They are analyzing the volume, the depth of the sell-off, the speed of the recovery or lack thereof, the behavior of different market participants, and the broader macro context, and they are waiting for the right moment to deploy capital, not rushing in blindly, not trying to catch the exact bottom, but waiting for confirmation that risk-reward has shifted back in favor of buyers, that the market structure has stabilized, and that the probability of further forced selling has diminished to acceptable levels. And this is exactly the approach that retail investors should be taking instead of making impulsive decisions based on fear, greed, or social media narratives that are designed to generate clicks rather than provide sound investment guidance. The gold market specifically is showing signs of technical damage that cannot be ignored, with the breakdown below key support levels opening the door to a potential move down to the next major support zone, which sits 15 to 20% below current levels. And while fundamentals suggest gold should be much higher given the macro environment, technical positioning matters in the short term, and right now the technical picture is bearish. Momentum is broken, and the burden of proof is on the bulls to show that buyers are willing to step in and defend lower levels with conviction, rather than just providing temporary bounces that get sold into by traders looking to exit damaged positions. The silver market is even more volatile and more dangerous right now because silver has higher beta to gold, meaning it moves faster in both directions, and the liquidation in silver was more severe on a percentage basis, with prices dropping through multiple support levels and triggering stop losses that created a cascade effect. And while silver has significant industrial demand that provides a fundamental floor, the paper market for silver is heavily manipulated, heavily traded by algorithms, and extremely sensitive to momentum shifts, which means buying silver right now is higher risk, higher reward compared to gold. And investors need to be honest with themselves about their risk tolerance and their ability to withstand potential further downside before committing capital. The opportunity cost of sitting in cash right now while waiting for confirmation is low, because if prices do stabilize and start moving higher, you will miss some of the initial bounce. But if prices continue dropping, you will avoid losses and preserve capital to deploy at better levels. And in volatile markets, preservation of capital is more important than trying to squeeze out every dollar of potential gain, because one major mistake, one poorly timed purchase, one over-leveraged position can wipe out months or years of gains, and the investors who survive and thrive in precious metals over the long term are the ones who respect volatility, who manage risk carefully, who do not get shaken out by corrections, and who have the discipline to wait for high-probability setups rather than forcing trades when market conditions are uncertain. The broader financial market context is also critical to understand because the liquidation in precious metals did not happen in isolation. It happened alongside moves in the dollar, in treasury yields, in equity markets, in commodity markets, and in currency markets, and all of these markets are interconnected. All of them influence each other, and all of them are being driven by the same macro forces, including Federal Reserve policy, inflation expectations, economic growth concerns, and geopolitical risk. And right now, those forces are creating volatility, creating uncertainty, and creating an environment where defensive positioning, careful risk management, and patience are more important than aggressive buying or aggressive selling based on short-term price moves that may reverse quickly. The physical precious metals market is showing resilience despite the paper market carnage, with dealers reporting steady buying interest, with premiums on popular products remaining elevated, with delivery times still extended, and with no signs of panic selling from retail investors who understand the difference between paper price fluctuations and long-term wealth preservation. And this divergence is bullish for the long term because it shows that the installed base of precious metals investors is not weak hands, is not traders, is not speculators looking to flip for quick profits, but rather is composed of informed investors who are holding for fundamental reasons and who view price drops as opportunities rather than reasons to panic. And this kind of strong holder base provides a foundation for the next major rally when conditions align. The institutional side of the market is where the liquidation occurred, with hedge funds, commodity trading advisors, and algorithmic trading systems all contributing to the selling pressure. And this is important to understand because institutional players use leverage, use stop losses, use risk management systems that force selling when certain thresholds are breached, and they are not necessarily making fundamental decisions about the value of gold and silver. They are managing risk according to models and rules that are designed to preserve capital and avoid catastrophic losses. And when these systems all trigger at the same time, you get liquidation events like what we saw today. And these events are painful, they are volatile, they shake confidence, but they also create opportunities for investors who are not forced sellers, who are not using leverage, and who can take the other side of panic selling by institutions that are dumping positions to meet margin calls. The lesson for retail investors is clear. Leverage is dangerous, chasing momentum is dangerous, buying without confirmation is dangerous, and making decisions based on emotion rather than analysis is dangerous. But precious metals as a long-term asset class remain attractive, remain relevant, and remain one of the best hedges against the monetary and fiscal insanity that is unfolding globally. And the $380 million liquidation does not change that thesis. It simply reminds us that the path higher will not be smooth, will not be predictable, and will include violent corrections that test conviction and punish weak positioning. And investors who can navigate this volatility, who can maintain discipline, who can think independently, and who can separate short-term noise from long-term signal, will be the ones who benefit most from the precious metals bull market that is still in its early stages despite today's carnage. The immediate action items are: do not panic buy, do not panic sell, assess your current positioning, evaluate your risk tolerance, determine whether you are over-leveraged or properly positioned, watch for signs that the liquidation has ended, monitor technical levels, monitor the dollar, monitor yields, monitor broader market conditions, and be ready to act when confirmation arrives that risk-reward has shifted back in favor of precious metals buyers. But until that confirmation arrives, patience is not just a virtue, it is a survival strategy in a market environment that is punishing impulsive decisions and rewarding those who wait for clarity before deploying capital into assets that remain volatile and uncertain in the short term, even as the long-term case remains compelling and intact. Financial disclaimer. The content presented in this script is for informational and educational purposes only and does not constitute financial advice, investment advice, trading advice, or any other form of professional advice. The analysis of market events, liquidations, price movements, and investment strategies discussed is based on publicly available information and market observations. But all investments in precious metals, commodities, and financial markets carry significant risk, including the risk of total loss of principal. Past performance is not indicative of future results. Gold and silver markets are highly volatile and can experience rapid and substantial price fluctuations. Viewers are strongly encouraged to conduct their own independent research, consult with licensed financial advisors, certified investment professionals, and qualified tax advisors, and carefully consider their individual financial situation, investment objectives, risk tolerance, and time horizon before making any investment or trading decisions. The author and publisher of this content make no representations or warranties regarding the accuracy, completeness, timeliness, or suitability of the information provided, and disclaim any liability for financial losses, damages, or adverse consequences resulting from reliance on this content or from investment decisions made based on this information.